by the time the damage is done and people want to make a change, it's usually closer to the bottom. And then by the time they could feel comfortable and it's safe to go back into the water again, the market has already returned back above where they got out. And so they missed that return, and it's permanently damaging to portfolios.
Brian, what are we talking about today?
Behavior and market volatility.
Oh, wow. Those are two big words there. Behavior and market volatility?
Behavior, market volatility. So you're used to my behavior by now. So what does it all mean? So to drill a little deeper into what behavior and market volatility is, just when financial markets go haywire, meaning they go down a lot, or they have really short periods where things drop a lot,
or they go way up,
that
makes everyone very happy.
That's right. And so it's really putting human behavior into the equation when you're thinking about investing or thinking about how you react to it. And I would say when people ask, like, oh, what, with financial advice, you had to like go study all this stuff and like get all the nitty gritty of like what markets are, what securities are, all this stuff. I always tell them, I'm like, that's about 10% of the job. They're like, what? And I said, the other 90% is behavior. And they're like, what does that mean? And I go, well,
yeah, what does that mean?
What does that mean? And
so you're telling me that your job is less technical than most people would probably think?
I would say when I was doing the advice side.
Okay.
And there's a technical part to it, and I exaggerate a little bit on the 90-10.
Yeah.
I'd say on the chief investment officer side, no, it's a lot more technical now. But the behavior side, like what I want to hit on with that in particular is it's nobody's fault. Like, it's okay to like have fear or greed in a way. Like, that's just how humans are wired up. Like,
yeah.
It's just, how do you manage it? It's just like when you have something that you're reacting to something, like how do you like try to control that so you don't do something that's damaging?
So you're saying it's okay to be upset when the market goes down or be happy when the market goes up?
That's fine.
It's just, okay, so how do you manage it? Tell us more about what you have done with clients.
So like let's start with the good stuff. Like,
okay.
Let's start
with
the
good stuff.
Let's start with the good stuff. So think about this way. Everybody that's investing, like they're seeing each other, like they're just the general market, the market. Once again, when I say the markets, what I really mean it's just people coming together to trade and to buy financial assets or to trade them. At the end of the day, they're all human beings. It's not like there's some like Wizard of Oz out there that's controlling it. It's the prices are determined by who's buying and who's selling every single day. And when the market in general goes crazy in the sense that things get too euphoric, so it's just like, this is never going to end. It's only going to go up. This is what's going to happen. Meaning like the narrative in the market is, it's like, there's just nothing bad.
Yeah.
That's what worries me the most, because I would say that's when people get overly aggressive. They start to assume, oh, I can handle this. This is easy. And when it gets easy, I get scared.
Okay, so why do you get scared? What do people do when they get in that euphoric stage?
They stop paying attention to the reality of what risks are. And they just don't think anything can ever go down. And they think everybody's going to stay in that mode forever.
Okay.
Or at least in the long-term future. They're like, this is just going to keep going. There's nothing that can derail it.
So they change their strategy then.
They'll push.
Or they can.
They can. And so sometimes what you'll see, and I'm not saying this is just across the board, but sometimes you'll see people say, well, I was in this strategy. It was built for the long term. It matches my goals. It does this. They'll start to say, well, can't we just eke out more return by cutting down some of that safe stuff in the portfolio that was there to protect when things get bad? And start depleting that to go buy the things that are doing really well.
So you said the word before. So greedy. They're getting a little greedy, right?
Getting a little greedy. And let's just call it what it is. You might be getting a little greedy. Okay. Now, sometimes that's good momentum to get people to maybe we were overly conservative to like start tweaking things a little bit. But in a lot of cases, it's, hey, I see everybody else doing this, like going up, and it sounds like it's going to be really good. So like, this is the time. And I always get really concerned with market narratives. We talk about,
and when you say market narratives, it's the headlines, the things that are in like the
Right.
newscast on a daily basis.
Right. And I'll use a very contemporary example of market narrative. So December of 2024, right? We had just come out of the election and all of that. There was a lot of call it political headlines that we were going to be like the best country, the exceptional country. So you heard US exceptionalism a lot. And what that translates to markets is markets, we're spelling the narrative of, hey, US stocks are going to do exceptionally well relative to everything else in the world that you can invest in. And that was the narrative, like, this is going to be great, deregulation, all these things. U.S. stocks are going to outperform international stocks, all of that. The U.S. dollar was going to remain strong, things like that. Well, so far we're now, into this year, pretty healthy into this year. That narrative couldn't be more of a 180. The dollar has declined about 10%. International stocks have outperformed by a large margin over U.S. Can it hold? I don't know. I mean, that it's likely, but no one can guarantee the future. But that whole narrative, buying too much into the narrative, was dangerous. And so if you were dumping things in your portfolio that were diversifiers because you thought nothing could go wrong with the U.S. market, well, something went wrong with the U.S. market and it got shocked in got shocked in April. And we saw almost a 20% decline in U.S. stocks in the month of April, which at that point, that's scary to people, right?
Yeah.
You wake up, let's say you're 100% U.S. stocks and like you just owned an index fund tracking the market, and you wake up in a few short days, you're down 20% on your portfolio. Like, your human brain is wired to say, oh my goodness, like, this is bad. Like, this is going to continue, bail.
Yeah.
Like, that's a very like gross example of it. So the initial reaction is, oh my God, I need to do something before it goes down more. And it could go down more, but the reality is the way you can control that behavior, to get back to your question, is really question, like, is this permanent or is this temporary? Do markets freak out periodically? The answer is yes, they do. They freak out. They're just like people. We all freak out once in a while. But the reality is if you really had that tied to the right long-term perspective, you really shouldn't be changing things, especially when it gets bad.
Well, you kind of danced around, like, it sounds like, a big headline you hear a lot or things that a lot of people talk about is timing the market.
Mm-hmm.
Like, can people time the market? Like, is that something that is really someone's able to do?
I'm going to pick apart your words here a little bit. Can you time the market? You can time the market.
Yes. Okay, fine.
I'm just being funny with you. Yes, there are individuals who have been able to successfully time the market. That is true. And I know that most of the time we're telling people they can't time the market.
Yeah.
The reality is most people who have timed the market, they have timed it once. And then every time thereafter, they got overconfident and they mistimed the market. So it's really, can you consistently
okay.
time the market?
Okay.
And it's not just one decision when to get out, it's when to get back in. Mm-hmm. Right? So if you can get out at the peak and get in at the bottom, that's perfection in timing markets. But to do that over and over consistently over a long period of time has been pretty much proven out that it doesn't work. And there are a small percentage of managers out there probably who can do it with high success rates, not 100%, but high success rates, but they're very hard to find and it's very inconsistent. So like what I generally see is the firms that have timed markets very well, investors don't stick with them. And you go, well, why don't they stick with them?
Yeah,
like,
why don't they actually?
They're good at it. The problem is they'll get the timing call right. So like this is typically how we see it. Their first go around, they'll get a really big call right. They'll sell at the peak. They'll get their clients all protected. and then things magically fall in a very short period of time after that.
Okay.
Like, right. So they got out at like the right time. And then what generally tends to happen with those is they might have protected. People start to notice that and they go, that manager's really smart. I'm going to go dump a bunch of money into it. And they time the manager's talent, and they flood the manager with capital, and the manager may still be bearish, and the market starts to recover. Usually it starts to recover in the worst periods of time, like when things are still very negative, and they missed that run. They got in too late on that manager style, is an example of it.
So what do you recommend then? Like what's kind of our philosophy or your philosophy?
I'll go with the philosophy I have, and I've just seen this over about 20 years of seeing a bunch of a bunch of reasons on why to sell the market, meaning get out.
Yeah.
Historically, they're short-lived, and that doesn't mean like two days or 2 weeks. Sometimes it's over a year, but
right.
Typically what I've seen is by the time the damage is done and people want to make a change, it's usually closer to the bottom. And then by the time they could feel comfortable and it's safe to go back into the water again, the market has already returned back above where they got out. And so they missed that return, and it's permanently damaging to portfolios. I mean, we've seen it. I mean, we have a lot of data on it, but clients that hold on and stick with the long-term strategy generally have had more success in their financial planning than those who permanently get out and then get back in later when they think it's an all clear. And the reason for it's not intuitive with financial markets, but when markets go down a lot, they tend to start recovering even when the headlines are still terrible. And so if you're waiting for really good headlines to come in, the market is always pricing the future. And so if the people who are participating think things will get better than where they currently are, where headlines are today, the market will start to reprice that in the future very fast before the headlines show up and say, everything's great again. So that's like it's the most tricky thing with the human brain. Like as markets recover, usually you see bad headlines, you're like, oh, this is a fake rally. Like you can't believe it. It's going to fall back down.
Yeah.
It historically doesn't.
And so obviously me and you have been here a long time, so we've been through some pretty interesting market cycles. Like what do you tell clients to do? Like obviously you acknowledge that they have emotions. Like what other things or tactics can they do to maybe calm those nerves?
So a lot of the time just letting people talk is soothing in and of itself.
Okay.
Also, if you can determine like, okay, what's the path out of this? And a lot of the time it's not very clear, but you can kind of
Yeah,
look
I was going
back.
to say, what do you mean by that?
So what's going on? Why is this happening right now? Like
Okay.
what is causing this? And is there any sort of catalyst that could potentially be wrong or potentially be right that they're not thinking about?
Okay.
A lot of the time just having to be able to point to things like diversification. So if you're properly diversified, things in your portfolio should not all go up at the same time and should not all go down at the same time.
So there's different buckets of investments.
Right. And so typically like what you'll see is people will have short-term cash reserves that they hold on the side. They can look at that and go, that's my safe money. I can let this stuff recover over here.
Yeah.
But like within diversification, what you're essentially recognizing, like, so when I say the word diversification, people go, that sounds cool, but it doesn't always work. And I'm like, it doesn't always work, right?
Yeah, that's a true statement.
It's a true statement. But they're like, well, why diversify when you should know exactly what's going to happen tomorrow? I'm like, nobody knows what's going to happen tomorrow. But with diversification, what you're essentially admitting, both from an advisor and a client standpoint, is I don't know what the future outcome is going to be of everything in there. Mm-hmm. And the reason you diversify, like just even diversify certain things in life that are non-financial, is because you just don't know.
Yeah.
And so that's usually what you're admitting when you diversify, is that I don't have certainty. And there's never certainty in life. Like I will say that. I love when I hear, oh, there's so much uncertainty. And I sit there and I'm like, there's always uncertainty.
I was going to say, there's always, I think the moment you think things are going well in life is usually when you get, what's the saying? You get like hit in the stomach or whatever.
Yeah, you get knocked down a peg or two.
Yeah.
You get overconfident and you get knocked down a peg. And diversification is a humble way to say, don't know, and be truthful about it. It's not, we're going to, like I hear this, we're going to overweight that, we're going to do this. And like, it's
all very complicated. I'll be honest.
Is.
And it's overwhelming, I think, to normal people that haven't like grown up in this industry. Mm-hmm. You know, talking to my husband, he's always like, I see this headline, I see that headline. I'm like, just ignore it. Like, that's not something that we're focused on right now.
Right.
But I think it's easier said than done, because I think in our minds, we've been trained to think this way. Like when we have downturns, do I run and go look at my 401k? No, I don't, because I was told by JC years ago, don't even look. You don't need to pull on those assets for a very long time. Right. But like, I think it's hard for like the normal person that hasn't grown up in this industry to have that.
That's right.
Mindset.
That's right. And I will say that if you're watching financial news every day, that's fine.
Is it?
If it floats your boat, go for it. Because I have to do it too. So it's like I have to see it. But one of the things that you eventually can train yourself on is what is just entertainment versus what is actionable.
Okay. That's a good way to think about it.
And you probably are looking at me going, why is that entertaining?
Well, I don't do the financial news.
If you think about it, and I don't track this and write it down every single day, but if you think about even through like good periods, bad periods, all that, do you really ever see an abundance of positive news in mainstream financial media? And we're just talking financial news.
Yeah.
No.
It's always the negative.
No, you can see a really bad headline, but once you read the article, you're sitting there going, okay, you didn't have anything that was of like fear that headline drove, but it got me to click on it. And so a lot of the time, like day to day, they have to publish. It's not like they can come out once a month with like a 3-page white paper and say, here's the news for the month. And we're going to go away for another month.
Right.
They have to publish nonstop. And a lot of the time, what gets people to stay and keep coming back is negativity. And that's the really hard part, because there's some good stuff out there. It's just really hard to find.
Well, where would you find it? Like, are there good news sources to kind of cover the financial type news?
There are. I'm going to give you a terrible answer. I won't disclose them on here because it's probably marketing for those. But there are ways to read things and get a long-term perspective versus what's happening today. There's obviously lots of educational resources. We do them for.
I was going to say we put out some.
We try to put out
information,
stuff like that, but there's a lot of it. And we're not the only ones that do it, but we try to cut through the noise, and the noise is really what I would say really sparks the short-term behavior reaction. It's, do I run away? Do I run in? It's that human flight or flight mechanism that they're trying to trigger. So the behavior side, I would say we can't put a number to it, but a high percentage of your success probably with financial matters is behavior. It's doing the right things consistently over again and not letting the day-to-day noise really derail you, kind of lure you away. So you kind of got to like rope yourself in and say, I committed to this in a good period. So like make a good plan in a good period when you're not stressed.
Right.
Stick through it when the stress does show up, and it will show up. So I think the biggest coaching thing is believe when you hear, whether it's an advisor that gives this to you or you come to this own conclusion, believe when you hear things will not always be as good in all periods. They will go through cycles. And as long as you recognize that when you go in with a plan, you're going to hit some speed bumps along the way. And it's just how do you manage those speed bumps? Do you ride over them or do you hit the brakes full on and stop the car? The other things that I would say from a behavioral standpoint is, one of the common things I see isn't on the negative side, it's the greed side. We'll go back to that again.
Yeah.
So diversification, you're going to own different types of things that behave differently and have different reasons for behaving, right? And when one thing is doing really well in the portfolio, I can pretty much tell with a client or anyone, if they come and they're like, hey, that's doing really well, let's buy more, I can probably guess they're an optimist. If they're coming to meetings and going, hey, I noticed this one's down for the month or down for the quarter, I can probably tell they're a pessimist.
Okay.
So if you're just focusing on individual pieces of a broad diversified portfolio, I'd say that's probably damaging in the sense that you need to look at how the direction of the overall pie is moving. Like, is it going in the direction that it should be? If it's not, why? Ask those questions. And there's probably usually a good reason for that.
Well, what are some other questions you should ask when you're kind of evaluating that?
So I would say, first and foremost, ask open-ended questions. Don't come with a preconceived notion of this is why it happened.
Let's get an example of that. Like, what's an open-ended question you would ask?
So I noticed that a very common one, right? If
Yeah.
you're really looking at your portfolio every day, which I try to tell people not to do, but you know what? Well, I do the same thing.
Oh, no.
I get it, but I just don't react to it. Like, at the end of the day, I just don't react to it. If you're looking, if you own a diversified portfolio, common thing that's been happening the last couple of years is you hear U.S. stocks were up for the day. I heard it. I was on the TV, all that. They'll go and look at their portfolio and they're like, my portfolio didn't go up as much as the U.S. stock market did. And you have to kind of take a step back. Do you own 100% of the U.S. market in your portfolio? You might not.
Yeah.
And you might have things that when the market goes down, you don't call and say, hey, why didn't my portfolio go down as much?
Yeah.
It's almost like, hey, I just noticed the behavior of this. I want to learn about why it behaves like this day to day. And there's usually a pretty good reason for it.
What other questions are you hearing? Obviously, people talk about this, especially when they're doing well. Mm-hmm. How do you combat those kind of conversations? Because, wherever you are, they're talking about how they're doing well. If they're doing well.
So, I'm a kind of a cynic, and so yes. I say things, and I try to be polite about it. But usually, when somebody's like, "Oh, a friend told me they're just killing it on all these things," I'm like, "Have they ever told you about a bad outcome?"
Oh, that's a good question. That's a really good question.
Just have they ever told you about? Because we all know people that will tell you only the good; they'll never tell you the bad.
Right.
And that's how they're wired up.
Right.
And one of the funniest things we hear is sometimes people will poke at poke at a piece of their portfolio. They might have other assets that we're not managing. That's okay. And they'll give us visibility to see what they're doing. Mm-hmm. So they'll come and poke at our portfolio, and then you kind of just ask them, well, I notice over here, that's not doing so hot. And they're like, well, that's I'm not talking about that. And they just completely separate that bucket. It's like, oh, that doesn't matter right now.
Yeah.
And it's like, well, no, it does. So, I think sometimes with this, the behavior side is so critical that some people can manage it really well on their own. Mm-hmm. And that's great.
That's good, yeah.
If you've got that attribute and you can manage your behavior and you know how to behave, and you're successful with it, great. Sometimes people need that help to talk to somebody and say, hey, I'm scared, but I need to get it out. I need to know that we have a plan. And that's sometimes 99% of just getting them to ride through it.
So empathize with them, listen to them, redirect them back to their goals, make sure they understand, hey, remember, this is what we talked about in good times.
Right. This
is what we're still heading for. We just have to get through this kind of bit of turbulence.
Right. So there's good chemistry between the two people that are working together. That's usually one good way to do it. But though I will say what I have seen not work very well is when you go into those conversations, and I've been guilty of this too, you go into those conversations data heavy and you don't listen.
You try and prove.
And you try to prove and you don't listen.
Yeah.
And we're all guilty of not listening at some point in time, and you just have to recognize a need to not do that because some people just don't respond to it. So
Right.
I obviously threw a lot at you with.
Yes, I'm a little overwhelmed over here.
You're a little overwhelmed. I'm losing you, Kelly. I'm losing you.
Just kidding.
No, but the reality is like, just to kind of quickly recap, like, behavior is probably your worst enemy as an investor. And I say that it's not the market, it's not all the stuff, it's just how you react to it and cutting through the noise at the end of the day. And being able to recognize, like, make a good plan when you're not under stress and when markets aren't under stress. Sometimes you don't have that luxury and you have to make a decision. Like, you don't get to pick the day the market goes crazy. But you really have like a plan that you put in place when you're not under duress, and then recognize that there are going to be periods that you won't foresee happening that will come along, speed bumps, if you will.
Yeah.
And it's just recognizing I set this in place for a reason. Nothing has changed in my life. I don't need to react to it. So I would say really like focusing on how you're feeling, because most of the time that emotional reaction is trying to lure you away to make a bad decision.
Yeah. So acknowledge it, talk about it, but kind of don't make any changes. Like, if you're really feeling scared, then talk to someone else about it.
That's right.
So,
before you just do something. And we've got it so easy now. You can do a lot very fast in this era where you can click your phone and sell in a heartbeat.
Yeah.
And I would say that's not the best strategy probably to employ.
Yeah. Unfortunately, we've seen it go the other way.
That's right.
And they haven't been able to recover.
That's right.
Well, we have a lot more to talk about as far as behavioral finance goes, and kind of how people react to different kinds of markets. But I know we're at time for today. So if you want to learn more about this topic or have questions, check us out at halberthargrove.com. Follow us on YouTube, or you can definitely ask Brian or myself direct questions on LinkedIn. Thanks so much for joining us on Fearless Money Talks.